Hey everyone, and welcome back to Talk Tickers, the show where we like to say we take the snooze fest out of earnings calls.
You know those long, jargon-filled corporate presentations?
Yeah, we dive into those.
But we promise to keep it interesting.
Insightful.
And dare I say, today we're putting on our stylish specs and focusing on Warby Parker's Q3 2024 earnings call, which just dropped on November 7th.
They've been making waves in the eyewear world for a while now.
But this latest report, it's packed with clues about where they're headed and what that means for investors.
It's like they found the secret recipe for success in a market where everyone else is losing their appetite.
What's fascinating here is their ability to defy the current economic gloom.
Okay, let's dive into those tasty numbers, shall we?
A lot of retailers are struggling.
They blew past their own projections, hitting $192.4 million in revenue.
But Warby Parker is not just surviving.
A 13.3% jump compared to last year.
They're thriving.
Now, I know percentages can sometimes be a little dry, but think of it this way.
And they're not just growing, they're growing profitably.
For every $100 they made last year, they're now making $113.30.
Their adjusted EBITDA margin, which basically measures how much profit they're making from their core operations, jumped to 9%.
That's a pretty significant leap, especially when you consider that many companies are just trying to stay afloat.
Their highest point all year.
It's like they've mastered the art of doing more with less, which is a skill we could all use in our own lives, am I right?
That's a really healthy sign, especially in a tough economy.
But here's what really caught my eye, their customer growth.
What's impressive is that their stores are playing a huge role in this growth.
They ended the quarter with 2.4 million active customers. That's a 5.6% increase.
They act like these stylish magnets, drawing people in and turning them into loyal Warby Parker fans.
And get this, their customer acquisition cost, basically how much they spend to attract each new customer, is staying steady.
It's proof that their omnichannel strategy, this seamless blend of online and offline experiences, is working like a charm.
Okay, let's unpack that omnichannel magic a bit more.
They've really nailed their marketing mix.
You can browse online, find frames you like, then pop into a store to try them on and get that perfect fit.
They're using everything from influencer campaigns on social media to streaming ads and targeted promotions.
It's like the best of both worlds, and it seems to be a key ingredient in their success.
It's a very data-driven approach, and it's paying off, especially when it comes to single vision glasses, which is their bread and butter.
But let's not forget their core product, glasses.
They're also riding the wave of the increasingly popular progressive lenses, which, as they pointed out on the call, still represents a big growth opportunity.
Sales were up about 10% year over year, and a lot of that has to do with their marketing savvy.
Don't forget that.
They're also constantly innovating with new lens options, stylish frame collections, and even foldable sunglasses.
It's like they're saying, hey, we can be both affordable and high fashion.
Did you know they launched a limited edition Italian collection?
And customers are eating it up.
But let's zoom out for a second and look at the bigger picture.
Their success isn't just about online sales or in-store sales. It's about how those two worlds work together.
It's like they've created this retail ecosystem where each part feeds the other.
They're expanding in both existing markets and new suburban areas.
In their strongest markets, they're seeing growth in both retail and e-commerce, which suggests a really powerful synergy.
And here's a mind-blowing fact. Over 50% of the major metropolitan areas they're in only have one Warby Parker store.
The retail revenue is up a whopping 20% year over year, thanks in part to the 13 new stores they opened during the quarter.
That means there's a huge runway for expansion.
And they're being very strategic about where they plant their flag.
Imagine walking down Main Street and seeing a Warby Parker on every corner.
Okay, maybe not every corner, but you get the idea.
Okay.
It's a pretty exciting prospect for them, right?
But it's not just about brick and mortar. Their e-commerce is also thriving.
But it's not just about brick and mortar.
Sales order value, basically how much people are spending per online order, was up in the mid-single digits, and that momentum is carrying over into Q4.
Their e-commerce is also thriving. Sales order value, basically how much people are spending per online order, was up in the mid-single digits, and that momentum is carrying over into Q4.
They're really firing on all cylinders.
But here's where it gets even more interesting. They're not content with just being the glasses people.
They're expanding their vision, so to speak, to become a one-stop shop for all things eye care.
They're like the Swiss Army knife of vision. I love that analogy.
They're really thinking long-term here.
But seriously, their contact lens business exploded this quarter, growing 35% year over year.
You come in for an eye exam, You need new glasses or contacts, maybe both.
In their eye exam business.
They're creating this cycle of customer loyalty that's very smart.
Up a whopping 40%.
And it's paying off. Customers who engage with multiple services like glasses and contacts are spending significantly more.
And speaking of smart moves, let's talk about their partnership with Versant Health, a subsidiary of MetLife.
This is a game changer, especially for their long-term growth.
This is a huge deal because it instantly adds millions of potential customers to their network, particularly those with vision insurance, through MetLife.
They've already seen success with partnerships like United Healthcare, and they expect this one to be even bigger.
It's all about making it easier for people to access quality, affordable eye care. And that's a mission that resonates with a lot of people.
It's a win-win for both Warby Parker and the millions of people who now have access to their stylish and affordable eyewear.
But hold on to your hats, folks, because they're not stopping there. Warby Parker is also setting its sights on the future. A future that includes smart glasses.
Now they're not just jumping on the tech bandwagon.
Now they're not just jumping on the tech bandwagon.
You're approaching this strategically.
They believe that the key to making smart glasses mainstream isn't just the hardware, it's the AI behind it.
They believe that the key to making smart glasses mainstream isn't just the hardware.
Think seamless integration with your other devices, personalized experiences, and maybe even augmented reality features that could change the way we see the world.
It's the AI behind it. Think seamless integration with your other devices, personalized experiences, and maybe even augmented reality features that could change the way we see the world.
That's mind-blowing stuff, right?
It's mind-blowing stuff.
And they're confident that with their strong brand design expertise and huge distribution network, they'll be a top partner for tech giants looking to crack this market.
And they're confident that with their strong brand design expertise and huge distribution network, they'll be a top partner for tech giants looking to crack this market.
It's like they're saying, hey, Apple, Google, we're ready when you are us.
It's a fascinating glimpse into how Warby Parker is thinking about the future and how they plan to stay ahead of the curve.
It's like they're saying, hey, Apple, Google.
But you know what time it is, right?
Oh, you know it.
It's time for our This Is Not Financial Advice segment.
Oh, you know it. It's time for our This Is Not Financial Advice segment. Just
Sure.
a friendly reminder that this is purely for entertainment and should not be construed as well. You know?
Just a friendly reminder that this is purely for entertainment and should not be construed as well, you know?
Financial advice.
Financial advice, we're just here to have some fun, explore some outrageous but plausible trade ideas based on what we've learned, and maybe get your creative juices flowing.
So considering Warby Parker's interest in smart glasses and their potential to become a major player in that market, our outrageous but plausible trade idea for today is this buy call options on Warby Parker stock with a long expiration date.
Now, why would we even entertain such a bold move?
Now, why would we even entertain such a bold move?
Well, if Warby Parker becomes the go-to eyewear brand for smart glasses, partnering with the likes of Apple or Google, their valuation could skyrocket.
Imagine a world where Warby Parker is as synonymous with smart glasses as they are with stylish and affordable prescription eyewear.
It's a bet on their ability to dominate not just the eyewear market, but a whole new frontier of technology and fashion.
That's the kind of scenario these call options represent, a bet on their future as a tech titan.
But remember, this is purely hypothetical.
But remember, this is purely hypothetical. We're just throwing spaghetti at the wall here. Folks, do your own research. Consult a financial advisor, and don't blame us if your smart glasses suddenly start showing you cat videos instead of your stock portfolio.
We're just throwing spaghetti at the wall here, folks.
Well, I cannot emphasize that enough.
Do your own research, consult a financial advisor, and don't blame us if your smart glasses suddenly start showing you cat videos instead of your stock portfolio.
But before we wrap up this first act of our Warby Parker deep dive,
There's more, isn't there?
always stay tuned for part 2, where we'll roll up our sleeves and get into the nitty-gritty of their financial performance. We'll break down those impressive growth numbers and see what's really fueling their success.
Always.
You won't want to miss it.
Welcome back to Talk Tickers.
All right, let's break it down. We talked about their impressive overall growth.
It's time to put on our financial analyst hats and dig into the numbers behind Warby Parker's stellar performance.
But I'm curious about the specifics. Where should we start?
Let's talk stores. Warby Parker's retail footprint is a big part of their success story. They ended Q3 with a whopping 269 stores, a significant jump from the 227 they had this time last year.
And remember that mind-blowing stat we mentioned earlier? Over half of their major metropolitan markets
Exactly.
only have one store.
And the stores they already have are performing exceptionally well. Their retail revenues surged by about 20% year over year.
It's like they've just scratched the surface of their retail potential.
The average revenue per store for those open more than a year was a healthy $2.2 million. And here's the kicker.
Those shiny new stores are definitely contributing to that growth. But what about the stores that have been around for a while? Are they holding their own?
They're maintaining their target of a 35% four-wall margin.
Now, I know some of our listeners might not be familiar with that term.
It shows they've got a really efficient operation going on.
So basically it means that for every dollar they make in a store, they keep 35 cents as profit after covering all the costs associated with running that specific store. That's a pretty sweet deal.
But it's not just about selling glasses, right? They're also expanding their other services like eye exams.
Right, they're turning those stores into one-stop shops for all things eye care. How many stores offer eye exams now?
They added 45 net new eye exam locations in the last year, bringing their total to 228 stores offering eye exams. That's a whopping 85% of their entire store fleet.
Talk about a smart strategic move. They're catering to the growing demand for convenient and affordable eye care. And speaking of customers, let's talk about those eye-catching customer metrics they finished Q3 with 2.43 million active customers.
Which, as they clarified on the call, is a closer reflection of active households. So it's likely even more individuals are rocking Warby Parker frames. That's a 5.6% jump on a trailing 12-month basis.
And their average revenue per customer isn't slouching either. It hit $305, so it's a 4% increase year over year. That means people are not only buying more from Warby Parker, but they're also spending more per purchase. What's driving that trend?
Several factors are at play here. More people are opting for their premium lenses like progressives, which command a higher price tag. The popularity of both contact lenses and eye exams is also on the rise, and both those services contribute to higher average customer spend. Plus, their higher price frames are finding their way onto more faces.
So they're attracting more customers who are also spending more. That's a winning combination. Now, let's get into the nitty-gritty of their financials, starting with their gross margin. They reported an adjusted gross margin of 54.6% for Q3, which was slightly down from 54.8% in the same period last year.
This dip was actually anticipated, and it's quite interesting when you consider the different factors at play. They're seeing efficiencies in areas like customer shipping and their own optical labs. These initiatives are helping to lower their costs.
But those gains are being offset by the increasing focus on contact lenses and eye exams, as we discussed. Those services have lower gross margins than eyeglasses.
Right. But it's a strategic trade-off. Yeah. They're willing to accept a slightly lower margin on those services because they know it leads to higher customer lifetime value and strengthens their overall business.
It's all about playing the long game.
Exactly. They're building a loyal customer base that keeps coming back for more. Now, let's shift our focus to SG&A. For those who aren't familiar with the acronym, it stands for Selling General and Administrative Expenses. This category includes things like salaries, marketing, and general corporate overhead. Their adjusted SG&A came in at $100.6 million, or 52.3% of revenue for Q3.
That's down from 55% of revenue in the same quarter last year. So they're becoming more efficient with their spending. They're doing more with less, which is always a good sign.
And they're achieving this despite increasing their marketing spend to capitalize on those strong demand signals we talked about. They bumped it up from $19.7 million last year to $23.7 million this year. So they're investing more in attracting new customers while simultaneously lowering their overall SG&A as a percentage of revenue. It's a testament to their disciplined expense management and their ability to find cost savings in other areas.
All right, drum roll, please. It's time to reveal the all-important adjusted EBITDA for Q3. They generated $17.3 million, which translates to a 9% margin.
That's a significant improvement over the 6.5% margin they reported in the year-ago period. We're talking about 250 basis points of margin expansion. That's like going from a B+ to an A.
And that's their highest margin. They're clearly finding ways to grow their profits alongside the revenue. It's not just about getting bigger, it's about getting better.
Precisely. They're hitting that sweet spot of balancing growth and profitability, and they're doing it while navigating a challenging economic environment, which makes it even more impressive.
Okay, last but certainly not least, let's peek at their balance sheet. One thing that really stood out to me is that Warby Parker has been free cash flow positive for 6 consecutive quarters. That means they're generating more cash than they're spending, which is a sign of a healthy business.
It speaks to their efficient operations and their ability to manage their cash flow effectively. They ended Q3 with a hefty $251 million in cash, on hand.
That's a nice cushion to have. They can use that cash to further fuel their growth, whether it's opening more of those coveted stores, expanding their product offerings, or investing in strategic partnerships like the one with for Sandhill.
And don't forget, they also have an undrawn credit facility of $120 million, which they can increase to $175 million if needed. They're in a very strong financial position to continue executing their growth strategy.
It sounds like Warby Parker is hitting all the right notes, both financially and strategically. They're growing their revenue, expanding their margins, and generating cash. But the story doesn't end there. We still need to look ahead and see what Warby Parker's crystal ball reveals about their future.
Ah, yes, the always exciting guidance section. What are they expecting for the rest of the year and beyond? Well, that's what we'll be diving into in part 3 of this deep dive.
All right, Talk Takers listeners, it's time for the final act of our Warby Parker deep dive.
Their guidance for the rest of the year is quite optimistic.
We've covered their impressive Q3 performance,
They're seeing strong momentum in Q4.
their strategic wins, and even dared to dream up some outrageous trade ideas.
And based on that, they've raised their full-year revenue expectations.
But now we need to gaze into that crystal ball and see what Warby Parker's own projections tell us about their future.
They're now projecting revenue to land between $765 million and $768 million for the full year.
Ooh, that sounds promising. Give us the numbers. What kind of growth are they predicting?
That's a 14% to 15% jump compared to last year.
So they're expecting to maintain that double-digit growth rate.
And it's not just about top-line growth. They're also expecting to see their adjusted EBITDA margin expand to about 9.5% for the full year.
That's a powerful statement considering the economic headwinds many companies are facing.
That's roughly 170 basis point improvement year over year.
Okay, for those who aren't fluent in finance speak, that basically means they're becoming more efficient at turning their sales into actual profit. It's like fine-tuning a well-oiled machine.
Exactly. They're getting better at managing their costs and maximizing their profitability.
But let's talk about their physical expansion plans. Are they still on track to open 40 new stores this year?
Nope, they're still full steam ahead. They're on track to hit that 40-store target, and they've reiterated their long-term goal of having over 900 stores, which, as we discussed, is still just a fraction of the total optical shops out there.
That was their initial goal, if I remember correctly, as they had to scale back those ambitions.
So there's still plenty of room for them to grow their retail footprint.
But let's not forget about their other key growth areas, contact lenses and eye exams. What are their expectations for those segments?
They haven't given specific guidance on those individual segments, but they've made it clear that they see huge growth potential in both areas. Remember, their contact lens business is still well below the industry average, and the majority of their customers still get their eye exams elsewhere.
So there's a lot of market share up for grabs, and as they continue to integrate those services into their seamless omnichannel strategy, they're well positioned to capture it.
Right. They're building a holistic vision care ecosystem that caters to every need. And as we've discussed, customers who engage with multiple services tend to spend more and become more loyal. It's all about building those long-term relationships.
Makes sense. All right, let's zero in on their Q4 projections. What kind of numbers are they expecting for the final quarter of the year?
They're guiding for revenue between $184 million and $187 million for Q4. That translates to a 14% to 16% growth rate year over year.
So they're ending the year on a high note, but what about their profitability? Will they be able to maintain that impressive adjusted EBITDA margin?
Well, they're projecting an adjusted EBITDA margin of about 7.3% for Q4. That's a slight dip from the 9% they achieved in Q3.
Is that a cause for concern? Should we be hitting the panic button?
Not at all. There's a perfectly reasonable explanation for this. They typically see a seasonal decline in gross margin from Q3 to Q4. It's mainly due to a quirk in their accounting where some revenue from December gets deferred into Q1 of the following year.
Ah, the joys of accounting. But they're still expecting adjusted EBITDA margin expansion in Q4 compared to last year, right?
Yes, they believe they can achieve that through leverage within SG&A. They're continuing to find efficiencies in their staffing store operations and corporate expenses, and they plan to keep their marketing spend steady as a percentage of revenue, which will help boost profitability.
So even with a slight dip in Q4, they're still projecting strong overall profitability for the full year that's reassuring.
Absolutely, and they're guiding for their stock-based compensation to normalize to a range of 2% and 4% of net revenue next year. That will further boost their bottom line.
It sounds like Warby Parker is heading into 2025 with a lot of momentum. They've got a killer combination, a strong brand, a loyal customer base, a smart omnichannel strategy, and a laser focus on both growth and profitability.
I agree. They're a company that's constantly innovating and pushing the boundaries of what's possible in the eyewear industry. And with their foray into smart glasses, they're poised to become a major player in the tech world as well.
Well, it's been a fascinating deep dive into Warby Parker's Q3 earnings call. We've covered a lot of ground, but there's always more to explore, so keep those stylist specs on. Stay curious and join us again for another insightful journey into the world of earnings calls on Talk Tickers.
Until next time, happy investing. And remember, this was not financial advice.